everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is refinancing versus selling. If you're a long-time follower of my YouTube channel, you would have already known 1,000 times, if not 10,000 times, that the federal government earlier this year announced that there is going to be a tax rate increase. When you sell a rental property, the capital gain inclusion rate in the past was 50%, and now for individuals, it's going to be raised to 2/3 for any capital gain that's above and beyond $250,000. And for corporation and family trust or any other trust other than graduated rate trust, the inclusion rate is going to be increased to 2/3 immediately. There's no $250,000 exemption that follow the old rule at all altogether. We have a detailed video that you can refer back to on this tax change. Now that begs the question, now you are stuck with this rental properties, you don't really want to sell it, or you may own your rental portfolios primarily in your corporation. With this very short notice tax rate increase, you are not able to sell all your property altogether before June 25th. June 25th is the effective date of this new inclusion rate. So what are you going to do? One of the points that are brought up by my clients are that they would like to refinance. They would like to keep the property for at least until the next government comes into power. And they're secretly hoping, just like me, secretly hoping a different party is going to come in and essentially reverse this type of capital gain inclusion rate increase change. And so between now and then, there's still a long time. And between they would reverse their previous legislation. If you want to access your equity in the house, what other options do you have? So that leads to the question, or the other alternative, which is refinancing. Now, before I dive deeper into whether you should sell your property or refinance your property, if you find our video useful, make sure you give us a thumbs up and hit the subscribe button below. With that, let's get started. Okay, the first step to decide whether you should sell a property or obtain refinancing is to understand your goal. What are your goal of selling your property or considering selling that property? Or what's your goal of having that extra money in your hand? You could be one of those multiplex owner, apartment building. You need extra capital to improve the property because the property is under repairs and you would need hundreds of thousands of dollars to invest in the property in order to maintain the property. And that could be one of the reasons why you are interested in either selling or refinancing the property. You may be one of those people who are just drowning in debt and you really wanted to restructure it or lower your monthly debt servicing costs, monthly costs of operating your business. You could also be one of the people that, hey, like I'm sick and tired of being a landlord and therefore I just want to get out of the whole portfolio. Or you are extracting, your goal is to extract some of your equity or some money or create some capital from somewhere to invest in the United States. A lot of our clients are trying to do that now. And so everyone's situation is slightly different. Everyone's goals are different. And therefore the narrative or the interpretation of the numbers that we're going to get into in a moment would be also very different. So make sure that you understand your goal, and that would be your step one when it comes down to determining whether you should refinance or you should be selling. So let's use an example to explain a little bit of background information to set the stage. Let's say you own this property, you purchased it long time ago, maybe 10 years ago, and you own it since 10 years ago. So you bought it for a very low price of $250,000. Now the property is roughly worth about $850,000. And you owe a mortgage of about $320,000. So you refinance a couple of times. And we've done the calculation earlier in a previous video in terms of calculating the tax liability on that $600,000 gain. the capital gain is calculated taking the $850,000, the fair market value, minus the your purchase price of the property plus any capital improvement of the property. So in our example, it's 250. 850 minus 250, you make a $600,000 gain. So that basically covers the example that we have. Now we're going to look into the option of refinancing versus selling. Now let's look at the example under the refinancing side. The property is currently valued at $850,000. Now it's important to mention that you may think that the property is valued at $850,000. The bank would be the one that's sending the appraiser out to value your mortgage independently. So your $850 may or may not be the real $850,000. It's a good starting point to do the analysis, but at the end of the day, ultimately it depends on what the appraiser says. So let's say the appraiser actually says $850,000 and the bank is willing to lend you up to 65% loan to value, which is really good. In that particular scenario, the maximum you would be able to get from the bank, borrow from the bank, is $552,000 roughly, 65% multiplied by the fair market value of the property. Now, let's say you currently owe the bank about $320,000. And if you are able to refinance, you would need to pay the legal fees to refinance it, depending on whether you're using the legal fees amount. It really depends on the type of refinancing that you're doing. And sometimes if you're switching from one bank to another, the legal fees are going to cost more. But if you are refinancing within the same bank, the legal fees could be as low as $500. So it again depends on your situation, but make sure you account for the legal fees as well as the mortgage penalty. So if you have an old mortgage and you're refinancing it, you may need to pay the mortgage penalty back to the first lender, or you might have that mortgage penalty with the same bank. So it's important to account for those extra costs that you would have. And so ultimately, after paying out the initial mortgage and also the closing costs, in our example, this particular property, this investor would be able to clear roughly $230,000. Now, assuming this particular investor is also looking at the option of selling, current fair market value is roughly $850,000. Now, assuming that he's able to sell it for $850,000, he typically would work with the realtors, and then there's closing costs involved. And so with realtor and closing costs, we estimated the cost to be around $50,000 to sell the property. And then again, there could also be other mortgage termination charge, early administration charge, and all these other charges that we're not aware of. And we estimate that to be $5,000. So the net proceed from the sale of the property is roughly $795,000. Now, minus, and out of that $795,000, you have to pay, obviously, the bank first, the bank who holds the original mortgage. So the $320,000 is first being paid out. And then don't forget your ultimate business partner, CLA. You also need to pay CLA. This taxpayer would need to pay CLA an additional $200,000. Now, this $200,000 is based on the new 2/3 inclusion rate. And ultimately, the cash that is left over from the deal is about $275,000. And this taxpayer or this particular investor would be left with $275,000 if he chooses to sell. Now, if you look at the both scenario, you can see that if this particular investor chooses to refinance, he nets $230,500. If he chooses to sell, he is able to net $275,000. We're talking about a $45,000 delta. Now, it is a lot of money, but at the same time, these analyses do not cover the entire picture. Now, let me explain why it doesn't cover the entire picture. Now, so when you refinance a property, typically what it means is that you have a bigger mortgage. So your mortgage would have been increased from $320,000 to $552,000. Now, with the increased amount of mortgage, that means your monthly mortgage payment is going to be higher. If you're currently experiencing negative cash flow and you are trying to improve your monthly cash flow objective, refinancing to extract the money out of your property, investment property, may or may not be able to help you improve the cash flow. So you also need to plug this analysis essentially back to the objective that we talked about earlier on. Otherwise, it would not make sense. when we do the analysis. If your goal is to improve your cash flow situation, maybe it may not, refinancing would not be able to help you with that particular situation. You may be able to extract $230,000 out from your refinancing, and you may be able to use the $230,000 to pay down your credit card debt. Then maybe there is a reason to refinance a property. Now, on the flip side, if your objective is to improve your cash flow situation on a monthly basis, selling a property does not only reduce the amount of carrying costs that you would have, but you may also be able to use the cash left over to pay down the other debt as well. So going back again to your objective, what's your objective? What are your goals? If your goals are to reduce the amount of cash flow burden that you have, it may be worthwhile to consider selling rather than refinancing. So now that we've gone through kind of like a quantitative analysis, it's worthwhile to consider the qualitative side of the analysis. And here are a few points that we should look at when it comes down to refinancing versus selling the property. The advantage of refinancing is that it allows you to access the capital without paying the taxes. So you don't have to incur all these extra costs. You can still get to enjoy the future appreciation of the property, but now you're able to tap into the property and take the money out, and with essentially minimal amount of tax implication. Now, there is another video that I've done in the past to explain the tax implication of refinancing. There could be some tax implication. It's important to understand those tax implications when it comes down to refinancing as well. So it may or may not trigger that tax implication, but for majority of the people who own their properties in personal name, chances are there is minimal refinancing implication other than the interest deductibility of the new equity that's being pulled out. And other pros of refinancing is that you can choose there is flexibility of your refinancing. You may be refinancing just simply to lower your interest cost. So you may be refinancing from one bank, from your private loan, and move it over to an A lender. And that would allow you to lower your monthly carrying costs, and that's sufficient enough. You're not looking into extracting additional equity, you're just looking to lower your monthly carrying costs. It could then lead to improved cash flow as a result. So you still have the same rental income, but your monthly carrying cost is so much better, and now you would be able to afford to hire a property manager per se. So these can lead to different steps and different advantages as well. If you were to refinance the property, the funds that's being pulled from the property, if you're using it to repay shareholder loan, assuming that you put in the money into the corporation and you invest in a corporation structure, if the money is just to repay shareholder loan, the interest can continue to be tax deductible. So the refinance money, the interest related to the money, the equity that you take out, could still be tax deductible to a certain extent. This statement, you have to double check with your accountant because everyone's situation is different. So if you are able to refinance and get a bigger write-off and at the same time afford a better lifestyle and also enjoy the future appreciation of the property, refinancing could be for you. However, on the flip side, the downside of refinancing is that obviously you need to incur some closing costs depending on the lender that you work with. Sometimes you have to pay tens of thousands of dollars to secure the financing with them. There is a loan commitment fee involved depending on the project that you are involved in, especially on the commercial side, and you may also need to pay your mortgage broker a fee as well. So that it can come quite costly if you're not doing it carefully. Now, with refinancing, you're extracting more money and you're carrying a bigger amount of debt. And through this refinancing process, generally speaking, you're also allowed to extend the repayment term. Your repayment term, your amortization could be down to 10 years per se. And during the refinancing process, you have an option to extend it to lower your monthly cost. So from 10 years all the way to 25 years or even 30 years, depending on the type of mortgage that you're doing. So if you are able to do that, the term is extended depending on what your long-term objective is for the property. You may say, hey, Cherry, I don't want it to be extended, or I may actually want it to be extended. It could be work for you or against you, because if you are in the situation of thinking of retiring and you don't want to carry as much debt, extending it may be not as beneficial to you because you want a free and clear asset. On the other hand, if you are one of those people who are really interested in cash flow and you want to increase the cash flow of the property by extending that term of financing, you would be able to achieve lower your monthly payment and therefore increasing the monthly cash flow of your property. And the other side about refinancing, I think the biggest hurdle is the qualification of refinancing. In my quantitative analysis, I just assumed it's easy for me to make the assumption that you would be able to qualify for refinancing. And at the same time, it is not available for everybody. The bank, depending on your particular investment property type, they may look at the rental income and then the debt servicing ratio. And because the interest rate is so high right now, the debt servicing cost is high, and therefore the amount that you would be able to borrow from the bank is lower. On the other hand, if you are in the residential real estate investment market, a lot of the time, the bank is looking at you as the individual and how much debt you would be able to serve. So they would look at how much money you're making, the salary that you're making. If you have a higher amount of income, then it would help to qualify for mortgage. So depending on your particular situation, it may or may not be feasible for you to qualify for financing. And it's worthwhile going back to the bank or the mortgage broker to speak with them, have that conversation, and understand the possibility of getting the refinancing done to begin with. Now, lastly, we mentioned earlier, higher carrying costs. There is a higher carrying cost amount and more interest would have to be paid because you're refinancing. You're now, if you were refinancing to take out more equity, so your mortgage would be bigger. So for those of you who are refinancing just to lower the interest cost, changing the terms, it may not be higher in terms of the monthly carrying costs, but it could also be higher depending on what your objective is. So be careful with that. If it is a higher monthly carrying cost, you may want to reconstruct your cash flow projection of your rental property. To do your rental property cash flow projection after refinancing, is worthwhile doing that just so that you know how much negative cash flow you're looking at or how much cash flow carrying cost it has increased as a result of refinancing. And then you can make an informed decision if your initial motivation is purely driven by lowering your monthly carrying cost. Now, let's talk a little bit about selling. People need to consider a few things when it comes down to selling. Of course, the first thing first is tax, close and dearest and closest to my heart. You need to calculate the amount of taxes that you need to owe, so then you understand how much cash that you would be able to take out from the property. I've experienced that, and I've done calculation for clients before that they thought that they're selling off an asset, and at the end of the day, they actually need to pay into the property after paying CRA. So if you have refinanced the property multiple times, this could likely be the case, depending on the amount of refinancing you've got from the bank in the past. Another thing about selling is that once you sell, you liquidate the property. You're no longer able to enjoy the appreciation of the property. And as we all know, inflation is still a problem. Our government is still printing money. So our money is best parked with hard assets. And if you're just holding the money and you are not investing it, you are essentially losing the time value of money and essentially losing the value of money to the government's unlimited printing habit. Another consideration that you may want to think about is the transaction cost of selling. We mentioned earlier, we calculated in our example about $50,000 on $850,000 sale price. So sometimes the cost could be really, really prohibitive when it comes down to selling, and it may not be worthwhile realize the sale at that time, especially after paying for the cost of tax as well as repaying the mortgage amount. So it is worthwhile to calculate the amount of that you would need to pay in order for you to sell the property. Another thing that you want to consider is the lost rental income. Some people are relying on the rental income on a monthly basis to cover their expenses. Once you sell, you don't have that rental income, and if you are using that equity for some other investment, you may not have the same type of cash flow coming in. So it is important to look at your finances in the big picture, not just on this particular sale alone. Now that we cover the quantitative side of the analysis and the qualitative side of the analysis, again, before you make any rush into making the decision, it's important to look at your situation from both quantitative and qualitative analysis side, and also understand the market conditions, the tax implication, as well as your own particular goal and reason for doing either selling or refinancing. Make sure you talk to different type of professionals when it comes down to doing all these transactions, because refinancing, you will need to talk to the bank, your accountant, or mortgage broker. But when it comes down to selling, you need to talk to the real estate agent, again, your accountant as well. So look at your portfolio as a whole and make an informed decision. If you like our video, make sure you give us a thumbs up and hit the subscribe button below. Until next time, happy investing.